Your first $10,000 could potentially transform into a $1 million passive income machine. But only if you avoid the massive mistakes that destroy 90% of beginner portfolios. I'm about to show you 3 proven ETF investing strategies that could turn that $10,000 into serious dividend income over the next 20 years. We're talking about building real financial freedom here, not gambling on meme stocks. Here's what you'll discover today. The exact ETF portfolio strategies that have performed well in 2025, why most investors misunderstand dividend yield, and investment approaches that could potentially help build significant passive income, even if you're starting later in life. Educational disclaimer. This video is for informational and educational purposes only. It is not financial advice. But first, let me share something shocking. While most people are chasing quick gains, Harry, our example investor, quietly built a portfolio that now pays him $2,000 every single month in dividend income. And it all started with his first $10,000. Stick around because I'll reveal the exact blueprint he used, plus I'll show you which ETFs are dominating right now based on the latest research data. Before we dive into the strategies, you need to understand what's happening in 2025. The market isn't what it was 5 years ago. ETF investing has become the smart money's weapon of choice. Why? Because while individual stocks can explode or implode overnight, the right ETF portfolio gives you instant diversification and professional management at rock-bottom fees. Here's what the data shows for 2025. VTI, the total stock market ETF, is up 9.20% over the past year with a dividend yield of 1.28%. But that's just the foundation. SCHD, the dividend powerhouse, delivered 2.61% with a massive 3.89% dividend yield. And VUG, the growth monster? It crushed expectations with 11.69% returns. But here's where most investors mess up. They pick one ETF and think they're done. That's like building a house with only a hammer. The secret is combining these ETFs strategically. And that's exactly what I researched using Seeking Alpha's premium analytics platform. All the performance data you're seeing comes from their detailed ETF analysis tools. And if you want to dive deeper into this research yourself, I've got a 7-day free trial link in the description. Important note. All projections in this video use historical 10-year average returns, not current single-year performance. This gives us a more realistic long-term perspective based on how these ETFs have actually performed over complete market cycles. Why most $10,000 strategies fail? Most YouTube finance gurus tell you to dump everything into the S&P 500 and pray. That's not a strategy. That's hoping. The truth? A $10,000 lump sum alone won't change your life. But $10,000 plus fixed monthly contributions plus the right ETF mix? That's when magic happens. Harry learned this the hard way. He started with $10,000 in a single ETF, watched it grow slowly, and realized he was thinking too small. The breakthrough came when he switched to a monthly dividend strategy with systematic contributions. Here's the brutal reality. Your $10,000 needs to work harder than you do. And in 2025, that means dividend growth stocks combined with growth ETFs and strategic passive income positioning. I've tested 3 distinct strategies that could potentially transform your $10,000 into serious wealth. Each targets different risk tolerances and investor personalities. Strategy 1 is for conservative investors who want immediate dividend income with lower volatility. Perfect if you prioritize stability and steady cash flow. Strategy 2 is the balanced approach. Ideal if you want both growth potential and dividend income without going too aggressive. Strategy 3 is for aggressive investors who can handle higher volatility in exchange for maximum long-term wealth-building potential. No matter your risk tolerance, there's a strategy here that fits your financial goals. Let's dive into each one. Strategy number 1, the conservative income builder. This strategy is perfect if you want dividend income starting immediately with lower volatility. Allocation: 50% SCHD, Schwab US Dividend ETF, 30% XLU, Utilities Sector ETF, 20% SGOV, Short-Term Treasury ETF. Here's why this portfolio strategy works effectively. SCHD gives you that attractive 3.89% dividend yield from quality companies that have raised dividends for 13 consecutive years. XLU adds stability with a 2.82% yield and defensive characteristics. These companies literally power the economy. SGOV provides 4.62% yield with minimal volatility. Let's see how this plays out for Harry using historical average returns. Starting with $10,000 and adding $500 monthly. Year 5, portfolio could grow to $52,000, generating $1,935 in potential annual dividends. That's $161 flowing into his account every month. Year 10, the portfolio may reach $115,400 with $4,290 in potential annual dividend income. $358 monthly based on historical performance. Year 20, Harry's portfolio could reach $354,600, potentially generating $13,190 annually. That's $1,099 in monthly passive income. Year 30, the portfolio might reach $898,000 with $33,400 in potential annual dividends. $2,784 every single month based on these historical projections. Total contributions over 30 years, $190,000. But Harry's portfolio grew by over $708,000 beyond his contributions using historical average returns. If this kind of financial independence appeals to you, smash that like button right now. It helps other investors discover these strategies. And this is just strategy number 1. Wait until you see what happens when we add serious growth potential to the mix. Let me quickly explain how these projections work. I'm using monthly compounding with weighted historical 10-year average returns and current dividend yields. Every month, Harry's balance grows by the monthly rate, then adds his $500 contribution. Dividends are calculated by multiplying the total portfolio by the blended yield. This is exactly how compound growth works in real dividend portfolios. Strategy number 2. The Balanced Wealth Accelerator. This strategy balances dividend income with serious growth potential. Perfect for building long-term wealth. Allocation: 40% VTI, total stock market, 30% SCHD, dividend ETF, 20% VUG, growth ETF, 10% VXUS, international stocks. Here's why this portfolio is effective. VTI gives you exposure to 3,561 companies with a 12.3% historical 10-year average return. SCHD provides that reliable dividend income with 10.36% historical returns. VUG adds growth firepower with 15.41% historical average returns, while VXUS offers international diversification. Harry's journey with this strategy using historical averages. Year 5. Portfolio could grow to $58,700 with $1,216 in potential annual dividends. $101 monthly. Year 10. The magic of compounding kicks in. $146,600 portfolio potentially generating $3,035 annually, or $253 every month. Year 20. Harry's wealth could accelerate to $591,300 with $12,240 in potential annual dividend income. That's $1,020 monthly. Year 30. The portfolio might reach $2,038,900, generating $42,200 annually. $3,517 in monthly passive income. But here's where it gets crazy. By year 30, Harry has contributed $190,000, but his portfolio could grow by over $1,848,900 beyond his contributions based on historical performance patterns. That's the power of compound growth working with dividend reinvestment. Strategy number 3. The Wealth Maximizer. This is for aggressive investors who want maximum growth potential and don't mind higher volatility. Allocation: 50% VUG, growth ETF, 30% VTI, total market, 15% VXUS, international, 5% SCHD, dividend stability. This portfolio is built for financial freedom acceleration using historical performance data. VUG's 15.41% historical 10-year average returns dominate the allocation, while VTI provides broad market exposure with 12.3% historical returns. The small SCHD position offers some dividend income stability. Harry's potential wealth explosion using historical averages. Year 5. Portfolio could reach $61,100 with $764 in potential annual dividends. $64 monthly. Year 10. Compound growth could accelerate to $158,900 with $1,986 annually, $166 every month. Year 20. The portfolio might explode to $703,600, potentially generating $8,794 annually, $733 monthly. Year 30. Harry could be sitting on an incredible $2,696,100 with $33,700 in potential annual dividend income, $2,808 every single month. Total potential growth beyond contributions, $2,506,100 based on historical performance patterns. That's the difference between playing it safe and playing it smart with proven ETF strategies. Here's what separates winners from losers. Consistency beats timing every single time. Fixed monthly contributions are your secret weapon. Instead of trying to time the market or waiting for the perfect entry point, you invest the same amount every month regardless of market conditions. Why this works? When the market's down, your $500 buys more shares. When it's up, you're buying fewer shares but your existing holdings are worth more. This dollar-cost averaging smooths out volatility and builds wealth systematically. The key is automation. Set up automatic transfers from your checking account to your brokerage, then automatic investments into your chosen ETFs. Remove emotion from the equation entirely. Harry started with $10,000, but the real wealth came from that disciplined $500 monthly contribution. Over 30 years, those contributions totaled $190,000, but could potentially generate portfolio values ranging from $898,000 to $2,696,100 depending on strategy, based on historical ETF performance patterns. Let's be real about the risks. ETF investing isn't guaranteed money printing. Market downturns happen. Dividend yields can be cut. Growth stocks can crash. International markets can underperform for decades. But here's what the historical data shows. Diversified ETF portfolios with consistent contributions have recovered from every major market crash over the past decades. The key is not panicking when your portfolio drops 20% or 30%. SCHD's companies have raised dividends for an average of 13 years. These aren't startups that disappear overnight. VTI owns thousands of companies across every sector. VUG focuses on established growth companies, not speculative plays. Remember, all our projections use 10-year historical average returns to give you realistic expectations based on how these ETFs have actually performed through multiple market cycles. The biggest risk? Not starting. Every month you wait is a month of compound growth you'll never get back. Here's exactly what to do with your $10,000. Step 1. Open a Roth IRA if you're eligible. Tax-free growth for life. If not, use a taxable brokerage account. Step 2. Choose your strategy based on your risk tolerance and financial goals. Conservative income? Go with Strategy 1. Balanced growth? Choose Strategy 2. Maximum wealth building? Strategy 3 is your play. Step 3. Set up automatic monthly contributions. Start with whatever you can afford. Even $100 monthly makes a massive difference over time. Step 4. Rebalance annually, but otherwise leave it alone. ETF investing rewards patience, not constant tinkering. Step 5. Track your progress using tools like the Seeking Alpha platform I mentioned earlier. Their 7-day free trial link is in the description if you want to dive deeper into ETF analysis. Remember, this isn't about getting rich quick. It's about potentially building sustainable passive income and working toward financial independence over time using proven investment principles. Important: past performance does not guarantee future results. Market conditions, economic factors, and company fundamentals can change. Always consider your personal financial situation and risk tolerance before investing. Your $10,000 is either going to work for you or against you. Every day it sits earning 0.5%, inflation eats away at its value. But deployed strategically in the right ETF portfolio with fixed monthly contributions, it could potentially become the foundation of serious wealth. Harry started exactly where you are now. He chose consistency over complexity, dividend growth over speculation, and systematic investing over market timing. Which strategy resonates with your financial goals? Drop a comment below. Conservative income, balanced growth, or maximum wealth building? If this helped clarify your investment strategy, subscribe to the channel. And check out this video where I break down exactly how much dividend income you need to replace your salary entirely. Remember, the best time to plant a tree was 20 years ago. The second best time is today. Investment risk. Notice, all investments carry risk. Past performance doesn't guarantee future results. Projections are hypothetical based on historical data. Consult a financial advisor before investing.